Hello, my name is Kyle McClain, and I'm a partner and senior wealth manager here with Rame and Gorell Wealth Management. Today, we're going to be talking about maximizing the benefit of charitable deductions when giving to 501c3 designated organizations, such as faith-based, educational, or other similar entities. If you or someone you know could benefit from this strategy or the other services that our firm offers, feel free to contact our team for a complimentary consultation, where we will review your financial situation to determine opportunities for optimization from an investment, tax, estate planning, employer benefits, and retirement strategy perspective. The first critical element to understand when thinking about charitable giving is that for many, these gifts don't necessarily result in a tax deduction. Each year, taxpayers must decide between the standard deduction or itemized deductions. The standard deduction for married couples in 2026 is $32,200 and $16,100 for single filers. If your itemized deductions do not exceed the standard deduction, then your charitable giving will not generally reduce your tax liability. If you don't typically itemize your deductions, strategically timing when you make charitable gifts, as well as certain other deductible expenses, can get you over the hump to itemize deductions in years where you might not otherwise qualify. This strategy is called deduction lumping. While it can be complex, you don't need to be a high-income individual to take advantage. To help clarify how this strategy works, let's look at an example. Robert is a married working professional in Houston, Texas. His deductible expenditures include about $20,000 a year in property taxes on a $1 million home and $10,000 a year that he donates to charity. Under current law, Robert's itemized deductions for state and local taxes, as well as charitable donations, are $30,000 a year, which is not enough to surpass the $32,200 threshold for the standard deduction. Now, let's consider how Robert can utilize deduction lumping to maximize his charitable deductions. If Robert were to pay his property taxes for 2025 in January of 2026, which is a perfectly acceptable strategy, as well as gift his 2025 donations as a lump sum on January the 1st of 2026, and finally make his 2026 gifts to charities later in the year, and pay his 2026 property taxes in December of 2026, he would effectively move 2 years of deductions into a single tax year. By using this strategy, Robert's deductions look significantly different. He reaches a state and local tax deduction maximum of $40,000 for the 2026 tax year by paying both tax years during the 2026 calendar year. He also has an additional $20,000 charitable deduction by making his 2025 and 2026 donations in the 2026 year. This gives him a total of $60,000 of itemized deductions, a drastic increase over the standard deduction of $32,200. Furthermore, he still receives the standard deduction for the 2025 year, despite his itemized deductions being negligible. In this case, the deduction lumping strategy still provides an additional $27,800 of deductions over a 2-year period. Assuming a marginal tax rate of 24%, this strategy will save Robert nearly $7,000 over a 2-year period without a single change to his giving strategy aside from the timing of the gifts. This example is a great way to think about the timing element of various deductions. Another aspect to consider when making charitable gifts is making a gift of cash versus assets. In many instances, directly funding your charitable giving with cash you've already paid tax on is a mistake. Before one can write a check or give cash, this money must be earned as income or liquidated via the sale of an asset to generate the cash given. In general, gifting the asset directly can be a much smarter move. Let's consider an example of appreciated stock in an investment account. If one purchased shares of XYZ stock at $100 and several years later the shares are worth $200, there's a $100 long-term capital gain that will be taxable upon the sale of the stock. Most taxpayers are subject to a 15% tax rate for long-term capital gains, with some individuals taxed as highly as 20% or 23.8% depending on income and other factors. When liquidating an asset to give the cash to your charity of choice, or simply giving cash that you've already paid a higher income tax rate on, you miss out on the tax benefit of simply donating the appreciated asset. Alternatively, when utilizing an asset gift, the investor will receive a deduction for the fair market value of the stock, and the 501c3 organization does not pay a capital gains tax. In this way, an investor receives the full deduction, and no party ever pays the underlying capital gains tax. After covering these topics, we hope it's clear that optimizing your charitable giving can be more complex than most realize. Although it may not be the primary consideration when undertaking charitable giving, the charitable deduction associated with the giving is generally a significant benefit. It is essential to ensure that your charitable giving actually reduces your tax liability when and where possible. Let's review the two key charitable strategies we've discussed today. First, for the many investors that take the standard deduction each year, charitable giving will not necessarily lower their taxes. Undertaking some strategic planning to utilize deduction lumping may help these investors itemize deductions every other year and materially reduce total taxes paid. Finally, instead of selling investment assets and donating the cash, consider donating assets directly. This avoids capital gains tax and lets you deduct the full market value of the asset. You avoid a potentially hefty tax bill, and the charity receives the full value of the asset. At Raymond Gorell Wealth Management, we have over $1 billion in assets under management. And as a firm, we strive to serve as an effective one-stop shop for comprehensive retirement planning. The many CFP and CPA tax professionals on our staff specialize in helping our clients take advantage of advanced financial strategies to materially enhance their financial ability to enjoy their lives, both before and after retirement. We invite you to schedule a complimentary consultation with our team by giving us a call, sending us an email, or visiting our website today.